What is a fiscal deficit? Fiscal deficit happens when a government spends more money than it takes in through taxes and other sources of revenue in a given year. For example, if a government spends $100 billion but only takes in $80 billion in taxes, then there's a $20 billion deficit. Deficits can be caused by a number of factors, such as a decrease in tax revenue, an increase in spending, or both. For example, during the Great Recession, tax revenues fell and spending increased as more people needed government assistance. This led to a significant increase in the deficit. Now, deficits aren't always bad. In fact, they can be necessary and even beneficial. For example, during times of economic crisis, governments often run deficits because they need to spend more money to help support their citizens. However, deficits can become a problem if they're not managed properly. If a government runs a deficit for too many years in a row, it can end up in a position where it can't pay its debts. This is what happened in Greece in 2009. The government had been running deficits for years, and eventually, it was no longer able to pay its debt. This led to a major financial crisis in Greece, and the country has been struggling to recover ever since.